Okay, good afternoon. Welcome to the weekly take on the market. Today is Friday. It's just shouldn't take my glasses off here. It's the 8th, right? 8/8. It is almost 12 o'clock Pacific Standard Time. Market will be open for one more hour. This was the best time slot that I had to do the video. I'll be your host. My name's Scott St. Clair. I am the manager of the Premium Product Group here at Investors Business Daily. Please take a moment to read the disclaimer. I'm not licensed. I can't tell you how many stocks you should own, how much money you should put in the market, whether you should own or avoid Chinese stocks, how you should hold through earnings. I could go on and on. I get a lot of emails on that. And it's not that I don't want to answer them or even have, like, whether it's right or wrong, an opinion on all that stuff. It's just the compliance issue. I want to protect that. One of the great features of working at IBD is being able to invest our own money freely, and I don't want to mess that up. So I apologize if you get kind of a cookie cutter answer from me sometimes in an email, but that's the process. Now, these videos are vetted for compliance, so I do try to address some of the questions that I get, and hopefully eventually I'll get to give you some information that might kind of go down the path of what you were looking for. All right, that being said, we'll do the same thing. Indices, instead of ETFs, I'm going to do a good trade, bad trade, try to get some feedback from that. Somebody asked me to walk them through a trade, told them I couldn't, but maybe I could do it on this video. And so we'll go through that, and then we'll see if people like it or dislike it or whatever, and go from there. And then the stocks to watch and the quote of the week. So let's start with the indices. And so the breadth of the market is poor. Everybody knows that. The market is top heavy. Everybody knows that. It has been for a long time. The market cap weight of the top 10% largest US stocks is the highest ever. And, the macro guy in me says this will end in tears, but the trader in me says it can go on a lot longer than you thought, and you just never know when it's going to end. So in 2020, we heard a lot of talk about how the breadth was bad, and you've just been hearing that and hearing that. So I just don't know how it's going to end. So in the end, I think it's fun to find these things and read about it. I love to read about market history and love to read macro and Substacks and all that. But honestly, I'm just always much better off just trading the micro. What's that stock doing? Do I like the business? What are the earnings and sales like? Can I get positioned correctly? Can I manage my risk? And on and on and on. I do think about the macro. So, for example, I own a couple of Chinese stocks, and I think there's geopolitical macro risks there. But I think there's geopolitical macro risks no matter where you invest. So you just have to learn to live with that and try to adjust accordingly, and know when to put, when to press and when to pull back, et cetera, et cetera. Sentiment, I just don't get it. I don't know what it is about sentiment, but remember, sentiment's a secondary indicator, and we've got more bears than bulls. I find that pretty surprising, considering the markets, I think somebody, I don't know if you follow me on Twitter, but I retweeted I don't remember which indicator it was, the McClellan oscillator or something like that, but it was like super oversold, and we were literally 2 days off of generational human highs on the S&P, and the this indicator was saying we were oversold. And maybe it worked, because I think the market rallied the very next day, like 1.5% or something. So a lot of these indicators, sometimes they work, sometimes they don't, which is why you'll hear a lot of old school traders just don't. It's just not part of their lexicon that much. But more bears than bulls, for whatever that's worth. Okay, before I get into good trade, bad trade, let me pull up the indexes, and we'll go through those. I'm going to turn my camera off so you can see the the chart better, just in case. And yeah, so here's, we had a little news failure, so to speak, on the, you had good news on Meta and Microsoft that day, and the market didn't close that well. Then you had a really bad gap down. I think there was some economic news, like a jobs report or something, but I just don't pay that close attention to realize. I think that's what happened. But now, look, the market's just marched higher. So the tape, which is the tape, what's the tape? The way stocks are trading, the price action is very strong. It's hard to argue with that. The S&P probably looks very similar, although not quite at new highs. There are some indexes that aren't all that great. IWM is just kind of a laggard, just hangs out. The Dow, let's pull up the diamond. Not that it's terrible, but look at the relative strength, straight down since the rally in look at that. That's when the relative strength peaked. So Dow's almost become like a safe haven. If the relative strength is on the Dow starts to outperform, that's probably a bad sign. The way it's constructed. And then maybe emerging markets. So EEM doesn't look all that bad, but it's just gone sideways for the longest time. Still not taking out the 21 highs, nor the 2008 peak as well. So all in all, I mean, the nice thing is you don't. For me, I don't trade the indexes that much. Now, the indexes are important because I do look at the relative strength line. So you have to compare the stock you're looking at or the index or the group you're looking at to something else. And the best way to do that is to compare it to the S&P. You can change that if you want, but I think I'm old school. I just compare it to the S&P. But yeah, I'm more like, I hope, I know I'm going to mess this up, but bottoms up. So I'm just looking for like, show me the best stocks. I just want to know where are the best stocks? Do they have earnings? Do they have sales? Do they have relative strength? Can I find a way to buy it? What do I do if I'm wrong, et cetera, and just rinse and repeat. And like everything, it has pros and cons, but in the long run, for me anyways, that works. I have to say pretty well. Let's look at like, so I guess, so here's China, KWEB, it's kind of going sideways. I don't know. I'll when I talk about stocks to watch, I'll pull up a couple of stocks, but this looks very strong to me. And there's you see you have like it tried, failed, and maybe this is the third time as a charm. Now it hasn't broken out yet, but gosh, it's just building base after base. And the nice thing is like you see you've got this big wide base, didn't work, and then you have kind of this straight up from the bottom, that didn't work. And then you get more of a uniform base, 30% correction, 10% handle. This looks very, very good. That didn't work, but this base is much tighter. Like, so it's not as deep, 28%. And look at the inside the base, you have that reversal, that's pretty strong. And so far the handle is 8%. So it's a little tighter than the previous base, which is what intrigues me. All right, so let's go into good trade, bad trade. Now, I want to preface good trade, bad trade. Oops, I put I'm gonna do FIG and MP. I put it in the wrong thing, but a good trade is not necessarily a trade that made money. A bad trade is not necessarily a trade that lost money. It's very, very important to understand that. If you've ever heard of like Pascal's wager, where you have there's four things that you can do, and if you're curious, look up Pascal's wager. It's the one thing I don't know why, but I so remember that from college philosophy is Pascal's wager. I don't know that this resonated with me from the sheer like probability standpoint, but that's like the matrix of you've got the trade that you followed your process that made money. You've got a trade where you followed your process that lost money. You've got a trade where you did not follow your process and made money. That can happen. And you have a trade where you did not follow your process and lost money. So there really are only two quadrants or two squares you want to be in. You want to follow your process. You want to be in both those squares. Now, just for the sake to make it easy, I've chosen two trades where they fit. I did not follow my process. Guess what? I lost money. I followed my process. I made money. So we're just going to leave it at that. So the first one is FIG, the IPO, and I'm going to use the intraday chart. So this was, well, first of all, let's pull up the chart. And so, if we follow like the process, right? Earnings last quarter are super good. The N in CAN SLIM, so to speak, the N in an IBD methodology, the new is there for sure. I love new companies, new IPOs, but where's the base? Like, where am I buying, right? So this is what I did. The stock jumped so strong that when it pulled back, I was super intrigued by it. And then when it closed really well this day, right there, that was right at the close, I bought the stock based on the 60-minute chart. So bad process. I bought it based on the 60-minute chart. Now, could it have worked? I really thought it would open higher and run and I would sell into it. But guess what? It opened lower. So next is, okay, so you have an expectation breaker. It did not do what I thought. Instead of opening up 5 or something like that I was going to sell into, it opened down 5. So what's the first thing I should do? Get in motion, start selling. Well, I froze. And then at 115 and at 110 and by 105 or something like that, it was Puke City. So now I'm sure glad that it was Puke City, because look where it is now, 78, 79, and I'm out like 25% ago, but I should have been out much better versus how I got out. So this was a bad trade for me. Bad process, bad outcome, bad all around. All right. Now let's go to MP for different. So MP Materials gaps up on, I think this was the news that the government is going to basically offer them a guaranteed income, so to speak. They're going to buy XYZ materials from them for the X number of years. And the market loved the news. And the stock was up, oh my gosh, 50% that day. I didn't even realize it was that much. So right away, it goes on my radar. And I would rather buy it on an undercut of those lows, like a little shakeout like that. It never did that. It held, and then it gapped up again. I don't know why. I can't recall why. Then it gapped up again. The stock was up 20%. Or maybe I've got the news wrong, but you get the idea. So this stock is in motion. Something is changing in the Wall Street is very quickly revaluing the company. I want to participate. So now it's like, how do I get in? So I'd rather undercut these lows and give me a chance to get in, and it didn't. So on this day, when it looked like it had a chance to undercut the lows, started to go down and then reverse, that's where I bought the stock. Now, this was a tough day to stomach there. You had a little bit of a reversal there. So I felt like I survived a bit of a shakeout. So I bought more there. So let's say I bought 1,000 at 55. I might buy another 200 at 57 and a half or something like that. And I don't remember, these are, close enough for government work as far as the numbers. And then a stock starts to rally again, and I'll add. I might buy another 100 shares. I might buy another 100 shares. I might get nervous here and sell 200-300 shares, but I'm not going to get completely out. And then here, I might press on the gas again and buy 500 shares or something like that. And I might have 1,700 shares. What would that account for? 10, 12, 14% of one of the accounts, something like that. That's usually what I'm kind of going for, so to speak, as far as position size. But I don't keep it so rules based and rigid. I'm more of, I'd like to have more of this. Feel like I can press the gas and I'll add a little bit, so to speak. So I'm not in there calculating, what do I have now? I've got 16% position. Okay, what is 18% position? 172 shares, go buy 172. I just don't do that. It's just not worth the effort, I don't think. I kind of mentally decide, okay, I want to add more. I'll just buy 200 because I'm going to do this across a number of accounts. Maybe on my daughter's Coverdale account, she has 100 shares, and so I might buy 30 shares. My son's Coverdale, he's younger. He might have 70 shares. I might buy another 20 shares for him. And my wife's IRA might be less than the Roth, and so on and so forth. So I'm just kind of mentally doing the math to try to match them up as close as I can. And then as the stock starts to rally, I'm usually going to peel some off. And then you have earnings, and I'm going to be, really very aggressively selling into something like that on earnings. Why? Well, I'm late to the game. I mean, here's the base the stock broke out of at 30. Here's the place where maybe I should have been more aggressive there at 48. My average cost is, let's say, about 60 by the time I've added and have a pretty good sized position. So I don't want to let it get away. I'm up maybe like 25, 26%, something like that. And so it's just a trade for me because of how I bought it. If I bought it down here, I might be more willing to leave it be. The way, it acted pretty well on the earnings. But I'm going to move off from it, and so I'm completely out of it as I sit here. Now, this is where it gets tricky. It's like I feel naked not having a position in it because I've had a position in it for a number of weeks here, and it's been one of my favorite names. And so I listen to podcasts about it, and you have these visions of it going to the moon. But the trader in me says that I'll find a better place somewhere along the line. I might not, and that can happen. And it might hood me, and hood. I did the same thing with hood, and it just kept going and going and going. But it also might, circle. So I bought circle here and sold, and then bought here and sold, and then bought here and sold, and now I'm done with it, at least for now. But if I don't sell into this, I've given back all the gains, and this was my biggest winner for the year so far. So that's why I tend to take them, especially if I'm buying them out of position versus buying them coming out of a really long base. Now, you might argue, Scott, it's coming out of a long base on the monthly chart, and you're probably right. And for maybe a more standard buy and hold investor, they put a 3% position to this or a 4% position, and they keep it for a year and triple their money. That's possible. I have no idea. Anything like that could happen. But because I'm using size, I'm going to be a little bit more proactive on the selling front on the way up. All right. So that was good trade, bad trade. And we'll stay the course with that going forward until otherwise noted. All right. So let's start looking at some stocks to watch. You've got I talked about MP. I think that's something that's in the universe of leaders. Hood. This stock is acting super well. Definitely a leader. If you own it, you just leave it. If you don't own it, I did buy it like this, but sold it fairly quickly the same day. Mistake. I just can't seem to get a foot. I did that with Hood twice. I bought it here and sold it like there, and bought it there and sold there, because it's hard for me to mentally buy them up here and hold it when I was buying down there and sold it something like that or like that. I can't remember. So Hood is one of the leaders. Palantir, definitely one of the leaders, just powering higher, very extended. I think like ripely extended. I think with Palantir, I'm just drawing it. It's not a really good trend line. Just made that up out of thin air, but I just think this is so ripe for a pullback. But gosh, I've thought that before. I thought that here, and I was right for half a minute. And so, but definitely huge leader. NBIS leadership. Now, not of the same quality as Hood or Palantir, but price action wise, sure is acting well. Some other stuff like FEIM, pretty thin. acting well. What else do I have on my list that I'm watching that's kind of different than maybe most people are watching? A-Lab, most people are probably watching that. Definite Leadership. This has been a tough one. This is more of a, I tried there, and tried there and gave up there. It's so funny because I think Chris Gessel said the same thing on IBD Live this morning. It's so funny that we both gave up at the exact wrong time. And that's probably why it ran. You shook out all the weak holders. The gold complex, AEM, is acting good. OR, I do own, is acting really good. And we never looked at gold. We might as well. I wish this would stop happening. I don't know why it does that. I think it's so weird. I don't know if it's a Zoom session because it doesn't happen to me when I'm not in the Zoom session. But that looks really good, building that base. NVIDIA. Now, these stocks are, you know what I'm going to do? I'm going to turn off the real time. I wonder, I'm on delayed data. So strange. So up 16 of 18 weeks, highly unusual action. Does that mean it has to go down? No, but I would expect something like that for that. Microsoft, kind of the same thing, up a bunch of weeks in a row. I'd expect some kind of consolidation. Carvana, gaps up on earnings. So far as giving back all of the gains. This is kind of why I like to wait on a gap up on earnings day to see how the stock holds. Today, for example, I was in PSIX and I did some selling into the gap up on earnings. And so far, it's not closing all that well. I felt awful when I was out at 114 or whatever on the open and the stock was like 120, but now it's at 99. That's partly why I sell, because I know myself. If I don't sell at 114, I'm going to sell at 99 in a fit of rage, so to speak. So I might as well just take 114 and watch it go to 120 and then see what happens. What else is out there? Semiconductors. Let's look at how they're acting. They're acting really well. I just think you should be in the mode of looking for ideas, and if you like them, you take it, and if you're wrong, you get out. Now, we are in the midst of earnings season. So far in earnings, I've had ARM go against me. I had to get, it got stopped on that one on the earnings. MP worked fairly well. PSIX worked well for me. It might not work as well for everyone else who probably would just hold it, but at least so far it's worked for me. Bloom Energy, a little bit difficult. Yeah, a little shakeout right there. But acting okay. I'm not in this one any longer either. Again, because I just didn't buy it very well. I bought it a bit late. You've had some, what else is earnings related? I feel like there's been one other one. Oh, Meta. I wasn't in Meta for earnings. Acted well. Now you have some bloodbaths, and you have to know that that's going to happen. Unfortunately, TSS or TSSI is the ticker. That gap down. Sezzle gap down pretty poorly. So for me, I didn't own either one of these, luckily. And so, you know, to have a big winner, you got to kind of sit through an earnings report, but it's frustrating if you sit and you get something like this. So, you know, you might have to adjust your position size accordingly, but to have a big winner, you've got to be willing to take risk into earnings. I just don't know any other way. They're not going to let you buy it. Get out for earnings and buy it back, get out for earnings and buy it back. And then, you know, 4 quarters later, you're up 180%. You've missed the risk of 4 quarterly earnings reports. I just don't see that as a possibility. So you got to get comfortable with the risk. It's unfortunate that it's become so much more risky and volatile than it used to be. But you take the good with the bad. Sometimes you get a PSIX and sometimes you get an ARM. So for me, I've had well, BE gap down, but I was able to withstand it barely. But I've had 2 gap downs on earnings, ARM and BE. I have a pretty good size loss in ARM percentage wise, but the position size was not monumental. It was adjusted accordingly. And then I've had PSIX and MP, and I feel like I had one other one that did. I was not in A lab. That's been really good. Unfortunately, I was not in A lab. I cannot think of the other one that I had that did really well. That's partly because it's kind of, for me, it's kind of, I try not to get too high on the wins and I try not to get too low on the losses. I try to just forget them if I'm done with a trade, at least in the short term. Oh, I know what the other one was. LEU. I was in LEU. And again, I'm in it. I bought here, I sold some into there. I bought here. I had to reduce. I bought here, and then I sold some into the earnings. And so far, it is what it is. I still like the name, but I want higher prices. I think that's it for those stocks. There's other stuff. Tesla looks interesting. I just it broke my trend line alert, but I just cannot bring myself to be long Tesla. The business is just deteriorating so rapidly, in my humble opinion. Now, I've been wrong on Tesla for so long that I don't even know why I even bother, but it's on everybody's radar. So I'm not doing anything with Tesla. It's just an avoid for me. The Ethereum, this is the Ethereum 2-time levered ETF. That looks really good. I mean, I'm really tempted to buy that yesterday. I wish I had. Runs up, goes sideways. Technically, that looks really strong. I love that setup. I just don't know what to make of Ethereum. I'm just kind of, I don't think anybody is really an expert on Ethereum, but I've just not really been playing all that much in the crypto place, unfortunately, because it's been a place to make some money. Coin and MSTR, these are the 2 you should watch to try to get, at least from a stock standpoint, as far as crypto, obviously. What else? Oh, in the Chinese. So this Futu, I own Futu. I talked about on IB Live. I'm having a hard time not owning a lot of Futu. Like, this just screams to me that this is going higher. I have a fairly good sized position, and I would have an irresponsibly long position if it was a US listed stock. I mean, I'm sorry, it is US listed. If it was US, right or wrong, the geopolitical risks obviously weigh on me, and the country risks are there. But China's been in a bear market for a long time, and this is like the Robinhood of China. And Robinhood has gone on a really long run, but like fundamentally, you're coming out of this really good base. The earnings line is turning up. The quarterly earnings, right or wrong, whether you believe them or not, those are really strong. Everything points fundamentally. It does have sponsorship, so there are a couple of hedge funds that I follow that have positions in it. No mutual. Well, let's look at the mutual funds. At least none of the IBD mutual funds have a position in it. I don't think any funds that I follow that I've flagged have a position in it. I wish that was the case. And that, again, that's what keeps me from having a much larger position than I do. If Fidelity Contra had a position and Druckenmiller had a position, I'd have a very large position in this stock. And then Baba is setting up cup with handle pattern. At this point, I'm going to wait for the breakout, and then I'll decide. I don't know. Maybe I'll buy it. Maybe I won't. But right now, I just own the Futu, FUTU. I think we can leave that as is. I'm looking at my screen, so bear with me on the pause on anything that I might have missed that I should mention. And I think I'm good. Okay. Let's go to the quote of the week. Nikolai Tangen, he is the CEO of Norges Bank. What does Norges Bank do? They manage the sovereign wealth fund of Norway. Hopefully I didn't mess that up. Fairly certain I got that right. And Sovereign Wealth Fund of Norway has done a really good job of managing big, big money, big money. But he said something I really liked. He says there are times, because when you have run big money, your objective is to you want to make money, but you also want to keep money, right? So you can't afford to you're not going to buy some of the stocks that I'm buying, right? You have to. They have a huge position like Nvidia, for example, or Apple probably, and Tesla. So protection of what you've made is important as well. But you have to try to stay ahead of inflation. You got to make money because you're probably sending money out to pensioners, et cetera. So says there are times when you just have to run naked. You have to take away the protection. You have to have market risks, and that's a real skill set. When to take away the brakes and go for it. I love that because there are times when I am pressing, and there are times when I've got the brakes on. There are times when I'm, fully on the brakes, no positions, cash, and full protection mode. And I just can't explain why exactly. Like I couldn't tell you in a perfect bubble why you would do one or the other. But the longer you do this and the more you immerse yourself in this and the more you study stock market history, the more you understand that there are risks out there, but how can I manage those risks? And where are those risks likely? Like if you're worried about a stock market crash, well, like how does markets crash historically? They don't usually just crash from brand new highs and in a single day. They go down for 2 or 3 days, go sideways for 2 or 3 days or weeks, and then break badly. So you'd look for that type of signal, right? You if you get a market bad break and it's just going sideways, doesn't mean it's going to crash, but you know that the parameters there are set up that that's might be a possibility. So you would be more on the brakes in a situation like that. So, and this comes to a lot like for the earnings, because a lot of people don't want to be in earnings. And I get it. There's nothing worse than, you're in a stock and you see it gapping down on after earnings after hours. It's disheartening for sure. Happened to me with ARM. And it'll happen to me again. But you just have to learn to run naked, so to speak, and take those risks, and know when to do that. And the best way to learn that, I think, is just with repetition, study, look at previous market history, previous cycles, previous big winners. How do they go up? How do they top? How do they go down? All right, so 800-831-2525, market surge at investors.com. We're experimenting a little bit with this video. I've got so much on my plate with a couple of things that we've got cooking that I'm not sure that I'm going to be able to do a video every week like previously. So I think I'm going to take this video to every other week, barring something drastic in the stock market that warrants a video for that week. So probably take next Friday off, and I'll be back the following Friday. Market surge at investors.com, 800-831-2525. Have a great weekend, everybody. I appreciate it. Thank you. Bye-bye.